Live.
Yep.
How are you, Hugh?
Good. How you doing?
Good, good. Can't complain. So, Hugh, you're the founder of Nexus Mutual, which is a decentralized alternative for insurance on Ethereum. I guess before we kind of dive deep into the details of Nexus, it'd be helpful to first maybe back up a little bit, talk about insurance mutuals in the real world, how they got started, the history, and like how they differ from insurance companies.
Yeah, cool. So insurance is like this really, really old concept, like thousands of years old. It's basically just a group of people coming together and sharing risks. So, like you get a community and perhaps someone in the community dies and then someone else looks after them and that type of thing. And so it's kind of like developed from there and become more and more structured over time. Like you can kind of go back to, I guess, a couple of examples like guilds in medieval times, where they used to pay an annual fee or whatever, and then if something happened, if they lost their lives, then their family would be looked after or something. So that's kind of the type of thing that that mutuals have kind of grown from. But then what happens is they tend to kind of hit a ceiling, because they have this kind of struggle to coordinate and grow larger, because when it comes down to it, insurance is all about sharing risk and diversifying risk. And so you need like lots and lots of different people, risks involved. And so it works better the larger the pool of people and the larger the risks are spread. And so like these little communities and guilds and things, they often struggle to get bigger because they kind of grow to a certain size of their community. They couldn't kind of get outside the community or group another community together because they kind of had their own little trust group and stuff. So what tended to happen is you ended up with this centralized insurance company, or kind of industrialized the process and kind of ended up with this shareholder company that kind of coordinated everything and brought it all together and made it more efficient and all that type of stuff. So that's kind of how things have generally progressed. And so what we're saying here, with Nexus, is that you can go back to that real kind of mutual approach where the members or the guild or whatever owns the whole thing, and they benefit from all of the when everyone pays the fees in, it's kind of jointly owned like a cooperative. So we're saying you can go back to that type of model because now we have this really powerful, essentially coordination tool with Ethereum and tokenization and things like that. So now we can coordinate action together on a peer-to-peer basis in a much more stronger way, because essentially we know what the rules of the game are through the smart contracts, and people can trust the rules of the game won't change, essentially. So that's kind of the fundamentals of what we're trying to do.
Mm-hmm. I remember you gave a really good interview last year, like talking about the history of mutuals, and like you mentioned how, the mutuals sector always steps in first before like the large insurance companies like figure out how to insure a new industry. And I think we're seeing history to kind of repeat the same with like DeFi smart contract risk, where like the big insurers like AIG, Lloyd's of London, like they probably don't even know like what the word DeFi is, or nor like understand how do you price these risks. So like the mutuals stepped in here with Nexus Mutual and like help offer like smart contract coverage before the big insurance players get in. So I guess that's a good segue to maybe diving deep into Nexus. There's a lot of people in the tier who probably aren't as familiar with Nexus, so it'd be good if you could get like everyone up to speed like what Nexus is.
Yeah, sure. So it's essentially a DAO, or like a community or a cooperative, and everyone kind of pools their money together, and then they decide as a group when to pay a claim. And so kind of stepping back, I guess there's kind of like a real like 4 different roles you can probably take within the mutual. The first and most obvious is kind of like, I want some protection. I'm interacting with a smart contract. I want to put some money in, say, Compound or Maker or something. And I'm worried that there's a technical bug. And so I'll go and do that, and then I'll get some cover on Nexus. So if there's a technical bug, I can get a claim payment. So that's just normal kind of insurance use case type thing. So that's kind of step 1. Role 1. Then we have to kind of have a few other roles in there to help make the whole system work. And one of them is probably just kind of more like a capital provider, so you can kind of contribute funds to the mutual and not really by cover, but kind of backstop everything as a broad group, sharing the risk and reward of the whole group. Then you've got some kind of more kind of like really kind of active functions that you need kind of more expert level engagement with. And so one of them would be assessing claims. So, if the claim comes in, what actually happened? Does it meet the terms and conditions? Do we want to pay out? And so you can get involved and vote on that. And the third one is probably like the risk assessment, which is kind of like the pricing or the underwriting side of things, where you can, first step would be to contribute funds to the mutual to kind of purchase the native token, NXM, and then you can stake that token against specific risks that you want to back. And so you're kind of like, the more people that back a specific risk, the like Compound or Maker, for example, the lower the price of cover. And the more capacity gets offered. So you're kind of determining the price using kind of like prediction market techniques. So it's basically quite a few different functions there, but and then the whole idea is that we have one kind of native token that kind of helps align the incentives at an overall level to kind of achieve the broader outcome of paying genuine claims and denying the fraudulent ones and stuff. So that's kind of the broad overview of how it works.
And on that topic, about like paying out claims, like one of the most commonly asked questions for Nexus is like, what's the incentive for mutual members to like honestly pay out claims? Like say there's like a big hack in Compound, the mutual is like responsible for like 20% of its capital pool in claims, and it's going to take a big hit. Why should the like NXM holders approve the claims rather than just like maliciously deny and like not have to take that hit?
Yeah, exactly. So, I mean, I think the first and most obvious thing is there's a direct conflict of interest here when you consider the short term. But what we can do with token economics is align those interests over a longer time frame. So when you think about an insurance company and the kind of mutual, I guess, is it never makes sense if you just focus on the short term to pay a claim. But it makes perfect sense to pay all genuine claims when you think about the long term, because if you start denying all the claims, then the mutual has no value and it'll just collapse. So basically what we have to do here is use token economics and staking mechanisms to have people lock up, stake for when they get involved in claims. And so they're kind of committed to the long term, and therefore if they start denying these genuine claims, then they're going to suffer financially. We also do have like a specific deterrent on the short term as well. So there is a smaller group of individuals called the advisory board as part of the mutual, and they can't decide on claims, but they can decide to destroy or burn the claims assessors' stakes if they deem there to be fraudulent voting. So that's never been used so far. But the point is there's a threat of direct financial consequence immediately for kind of attacking the system.
And like historically, I mean, to date, Nexus has actually like successfully paid out claims.
Yeah, exactly. So we've paid out claims and we've also denied some as well. I think one of the really interesting things is when we've assessed these particular cases is that there's a whole bunch of discussion in our channel, in our Discord channels and open and our social media and stuff like that about is it genuine, is it not, blah blah blah, and everyone comes in and puts up an opinion. But if you actually have a look at the on-chain votes about what the actual results are, it's been 99.9% either yes or no, one way or another. So it's been really clear from the voting, which I take as a really good outcome that people kind of are aligned when it comes down to it.
Yeah, and for everyone in the group, I posted a link in the chat to Nexus Tracker to the claims, so you can kind of see like the historical claims as well as like other data on Nexus. And like this is also one I found really interesting is that you'd expect there to be like controversy around like kind of the details of the cover wordings, what like exactly the insurance policy covers and what it doesn't. But like when you look at the actual voting data, it's like pretty like clear like what's a fraudulent claim and like what's a legit claim. And you can see that so far Nexus has paid out 3 claims for the BZX hack, which happened around this time last year actually. And so it's good to see that Nexus has a track record of actually working.
Yeah, and just a small note for anyone looking at all those claims, the vast majority of them are actually just people testing out the system. So there've been lots of declines, but yeah. But it's been really good so far. So we couldn't have hoped for better outcomes. But I mean, obviously we're doing some new stuff and it needs to be more battle tested, but it's definitely going in the right direction.
Now, another like commonly asked question that people have is there's a lot of different ways to do insurance. So there's the mutual model. You can do like prediction markets for insurance. You can have like financial derivatives like put options, credit default swaps, and like a bunch of other financial instruments. So like, how would you like compare the different approaches to doing insurance, and like, why did you settle on the mutual approach?
Yeah, I mean, fundamentally, I think there's two different models on a financial basis, perhaps. Well, there's probably three, but there's probably, I'll break it down to just two for the sake of simplicity. And it all comes back to how you collateralize the claims, the potential claims. So how do you use the funds that are in reserve to pay for claims? And so the insurance model is and the mutual model is to diversify risk massively across a whole bunch of different risks and under collateralize very, very heavily. So they're very leveraged. So they basically write, like AIG, for example, is like 60 times leveraged. So it writes 60 times more risk than it actually has capital on its books. So if everything that they ever wrote claimed at once, they'd only be able to pay out 1/60th of their liabilities. So the whole point there is that you can cover a whole bunch of stuff and you can be very capital efficient by getting diversification. And that's kind of really how the insurance model works and gets its capital efficiency. On the other end of the spectrum is kind of the prediction market, which has to be one-to-one backed. If you write $1,000 worth of risk, you have to have potentially $1,000 in the pot, and then to potentially pay out that claim. And if it's not paid out, it goes one way, and if it is paid out, it goes to the other side. And so what prediction markets work quite well at is where the probability of the event is relatively high. So, maybe greater than 5% is probably the minimum, but, it works better if it's 20 or 30% chance of something happening. Because then the person on the other side of the bet that says, no, I don't think there's going to be a claim, there's a reasonable return. If you're talking about extreme events, such as, probability of someone dying or something, which is kind of like roughly 1 in 1,000 every year, then if you're taking the other side of that bet, you basically can earn like way less than 1%. And so why would you take that? You're not efficiently deploying your capital. And so prediction markets work well for a whole bunch of stuff, but they don't, in my mind, work well for tail risk events. And for tail risk type events, you need to have this under collateralized model. And so that's really why we've used the mutual model as opposed to the fully collateralized prediction markets, or the derivatives we've seen so far in DeFi have been on the over collateralized end of the spectrum. Though maybe that's starting to evolve and change. And I think just more generally in DeFi, there's this trend towards capital efficiency. We've started at a really over collateralized level, and then we're moving towards more capital efficient models.
Mm-hmm. Yeah. On that note, a friend of mine, Josh Hanna, I really like a phrase that he says for prediction markets. It's like, it's just not worth it, like picking up pennies in front of a steamroller, because you don't know what you don't know. Which is why, like, if you look at in DeFi, there's been projects like Cover Protocol and others that have tried like other ways of doing insurance, but then they kind of run into the challenges that like have already happened in the real world, where you can't get the premiums to price to like 1 or 2% APY with prediction markets or like financial derivatives, just because it's not capital efficient.
Yeah, exactly. The economics break down for extreme events with prediction markets and that type of stuff. It just doesn't work. Yeah.
Yeah. I was also in the chat. I also posted a link to a blog post Hugh wrote a while back, kind of in more detail about all of like the different approaches to doing insurance. And also with the mutual model, I think right now Nexus is about like 2.5x leverage, right? You have 2.5x the amount of covers to the capital pool.
Yeah, that's right. So it's great that we've got some leverage in there. That's really good. But our goal is to really make that a lot larger and grow a lot bigger. So hopefully in a year or two we'll be at like 15 or 20 times or something like that. That's kind of where we want to get to.
Mm-hmm. And that's like really powerful because right now there's like $20 billion or so locked in DeFi. I think it's higher now. And like Nexus can like underwrite a lot of that with like very little money in the capital pool, as long as the risk is diversified. And I think right now Nexus like underwrites about 650 million is like of DeFi is covered, which is like pretty incredible. But there's a lot of upside from there.
Yeah, exactly. Yeah, 650 million on about 230 or something million of capital. So yeah, it's it's funny. Everyone's focusing on TVL, and I'm focusing on how much business we can write versus the capital that we actually have.
Yeah, if you look at the Nexus tracker, you can like see all the KPIs for Nexus, and things have been exploding, especially even like year to date, just like from January 1st to like now in just a month, things have like gone pretty crazy.
Yeah, I mean, I find this like one of this is just fascinating to me. Like, I've mentioned this to you before, Richard, but like whenever I show my insurance colleagues from my old world, that your tracker, it gives them real time view of exactly what's happening on Nexus. That they're kind of amazed, but then I tell them that you built it and we didn't even build it, that you could just do it by yourself. And that's when it gets really like, it really blows their mind, because it's just a totally different paradigm to what they're dealing with right now.
Yeah, that's like one crazy thing about DeFi compared to like traditional finance is like all the data is on chain and public, and like you get the data real time rather than like having to sift through PDFs and like quarterly updates, which is like really great for the industry.
Yeah, exactly. No more waiting 3 months for the end of year financial results to get reported.
Yeah. Moving on, I guess we should talk about the NXM token model. So like one great thing I find about the NXM token is it's extremely elegant. Um, I guess maybe you can kind of dive deep into like how the MCR works, like why it's elegant, how it incentivizes people to contribute capital, and like when it doesn't. You can dive deeper into all of that.
Yeah, so I guess like the whole principle behind our token model, which is a bit different. So we actually have a formula to drive the token model, so a bonding curve, it's also called, and rather than just let the token free float on the market. And so the whole purpose behind that is that we want the mutual to have enough capital to be able to pay its claims, but not too much capital. So it comes back to this capital efficiency thing, which is basically how insurance works. It's all capital efficiency. And so if the model is designed so that if the mutual grows and writes more business, then it needs to have more capital. And so we have this concept called the MCR, which is the minimum capital requirement, which basically represents how much capital we need to have based on the covers that we've actually got in force at the moment. And so when that goes up, that kind of drags the token price down, and encouraging more people to put money in because we're undercapitalized. When we have more money than we need, and so we have this kind of solvency ratio, which is the MCR percentage, which is the ratio of the funds that we have versus the MCR. And so when that solvency ratio kind of goes up high, then the token price also goes high and says, look, we'd have too much money, we don't need it, cash it out. And so basically that means you can burn your NXM into the bonding curve and get some ether out, and then that kind of takes money out of the pool, and burns the supply of tokens, some of the supply of tokens, and so it's kind of in this constant state of raising or distributing capital on a fully continuous basis. So an insurance company, the analogy there would, okay, once every year it might go to capital markets to raise a big chunk of money, and then once it's kind of got enough growth, then it might start spinning off excess profits that it doesn't need to reinvest, and so then it starts distributing dividends, and so all that's kind of manually done by the board and all of that type of thing, whereas here we've just basically got a formula that's doing it on a continuous basis.
Mm-hmm. Got it. I guess we can like look at the future roadmap of Nexus. So like one interesting thing that's been happening in the last few weeks is like we're starting to see third-party distributors offer like sell Nexus cover at the point of purchase. And this is kind of akin to in the real world how you have like the underwriters and you have the insurance brokers, where like the insurance brokers are the ones who actually like are interact face to face with the customers. So like maybe you could talk more about like those distributors like Armour and I Trust Finance and others.
Yeah, so within DeFi, what's happening now? Yeah, so Armour's just released, and then another one, I Trust Finance, will be coming soonish, hopefully, where they basically on sell Nexus cover, and they do a very slick UI and give some enhanced UX benefits to the consumer as well that are not natively available at the Nexus core protocol level. And so they really add value from that perspective, and they can really help with the composability within that DeFi ecosystem. And so I think more generally, our model that we're aiming for is a very like B2B to C type approach, where you have this distributor or someone in the middle. I guess the analogy in the traditional finance world is like kind of reinsurance as a service. So for example, you've got like all these insurance startups that have got a product and they want to sell to a particular market, do it, via apps or on Facebook or something like that. But then they have to go to a reinsurance provider or someone to get actual regulatory capital or insurance paper to actually sell the business. And so they become like a front of the insurance underwriter. So, whenever you get your insurance, it's like got a big flashy brand on it, but then in little print down the bottom, it says underwritten by AIG or someone, right? So conceptually, it's the same type of thing. Does all the flashy brand stuff, and then it's underwritten by Nexus in the background. And so that's conceptually the same type of thing we're going for. But because everything's on Ethereum and effectively open to integrate with on a trustless kind of basis, then we can really leverage this, and it doesn't take you a year to get a product up and running, because you've got to get an agreement with the insurance provider. You can just basically do it whenever you want. And so Armour have just done this. We've talked to them and stuff and helped them a little bit along the way, but essentially they've done it all themselves and haven't had to really get involved with us at all.
Mm-hmm. Briefly, could you talk about why, like in the traditional insurance world, like B2B to C is like a better approach rather than just like direct B2C?
I guess there's a lot of different pieces of the insurance value chain, underwriting, risk assessment, capital, investment management. There's kind of like more kind of technical stuff, which is probably what Nexus is likely to be better at, and the insurance companies or the reinsurance companies are better at. And then you've got like kind of the sales and the kind of distribution and stuff like that. So I guess one thing from a distribution point of view is insurance is always this secondary purchase. You're always doing something. You're always, buying a house, and then you got, a home and contents insurance, or you got a car and you get insurance on that, or you're going traveling and you get insurance on that. And so basically, you want, with the distribution, you want to hook it up with the primary product purchase to be as close to that as possible. And so distribution relationships are going to be key. And that's kind of the same type of approach we're going with here.
Mm-hmm. Got it. Last thing I want to talk about is about investment earnings. So there was actually a smart contract upgrade that happened on Monday for Nexus, which is really exciting, where the mutual can like now invest a percentage of its balance sheet, some of its assets in like different investment strategies and like earn returns. Like maybe you could talk a little bit more about that.
Yeah, this is a really massive strategic upgrade for us. Like, it hasn't actually impacted anything right now, but like this is critical for the long-term growth, because insurance companies tend to make, I don't know, half, they could even make even more money off the float. So they take money in, they sit on it, and then they pay it out as claims later. So they make investment earnings on the float. And a lot of product lines in regular insurance actually lose money on the combined ratio. So premiums plus expenses less claims. So they lose money on the core business, or just break even, and then they make all the money on the float. That's why Warren Buffett loves insurance companies. So basically, we haven't been actually enabling half of the business up until now, and there's reasons for that. But I mean, a large part of it is there haven't actually been a wide variety of assets within the Ethereum ecosystem, which we could make sense to invest in. But that's definitely changing. And so what we can do now, and what we're probably going to start with, is some sort of staked ETH token derivative. So we basically earn staking returns on our big ETH capital pool. And so once we start doing that, then we basically open up the second main revenue stream for the mutual, the investment earnings side. So yeah, it's really critical for long term. We haven't really started yet. We'll grow it gradually, but it'll make a big difference in the long term.
Hmm. Yeah, it's crazy that like you brought that up. I had no idea that like insurance companies invest so much of their balance sheets in like these yield-bearing assets, and like a lot of them are actually like negative in their core business model. Like when once you factor in the claims plus the premiums, like they're negative, but they make that up in investment earnings.
Yeah, it's a bit weird, and they often run like massive. They have big liquidity, like they invest in illiquid assets as well. So you know, there's kind of a bit of a spectrum there, and you know, there's a whole bunch of rules and regulations about what they can and can't do, obviously.
Mhm.
But still, it's a unknown bit hidden in the backwaters of the insurance industry, I guess.
And I guess like with DeFi and Nexus, like there's so many yield bearing opportunities right now. You can like invest Nexus like balance sheet in DeFi and like get like 10% APY or whatever. That's relatively low risk, or you can invest in E2 staking. So there's a lot of ways like to get a lot of cash flow for Nexus.
Yeah, exactly, and that cash flow just goes straight to the shared capital pool, and yeah, and goes all to all members, so it goes directly to essentially to the token holders.
Mhm. Cool. We're just about on time. Is there anything else you wanted to wrap up with?
No, I think just in general, we've probably got I guess other exciting roadmap stuff coming up. We're definitely looking at product enhancements and things like that. One of the interesting things about doing an entirely new product is you get some things right, but you don't quite get it all right. And so there's definitely some good enhancements that we've got coming out in terms of widening coverage of our policies, essentially, so that people are covered for more things, because risk in DeFi is definitely evolving pretty quickly,
Mhm.
especially last year. So so yeah, we're looking forward to kind of covering more people as we grow.
Yeah, I also like just like to mention, like Nexus isn't just only covering DeFi right now. They're also Nexus also expanded to centralized exchanges and custodian covers. And like actually, the very first exchange cover was purchased this morning. On someone purchased, I think it was like 100K cover on Kraken, which is really cool. So if Kraken gets hacked, or they like deposits and withdrawals are like halt suspended for like whatever, say regulatory reasons, then you can get a payout from Nexus.
Yeah, exactly. So we're trying to cover a whole bunch of different risks within the crypto space more generally, not just kind of DeFi. And we just see that there's a massive opportunity. And as you said right at the start, the traditional insurers aren't coming here yet because they don't know about it. Maybe it's not quite big enough yet. I don't know, but it requires a lot of brain power to get up to speed on it, I guess. And so we think there's a pretty massive opportunity within the wider crypto space to help out and people improve their risk position, really.
Cool, cool. Well, that's all I have. Thanks, Hugh.
Cool.